I'm creating a mini series where I'm going to be talking more in depth about the key metrics you need to be profitable when dollar cost averaging. I want to break it up into 4 separate parts. Number 1 being entries, number 2 exits, number 3 drawdown control, number 4 calculations and how to robustly test your strategy so you can find your own profitable strategy. So I think that it's only right that we start episode 1 with our entries, add-on trades and risk management. So let's get into it. So our 2 entries are a higher time frame RSI extension and then a moving average cross on a lower time frame. So we're looking at the RSI periods and time frames as well as what moving average cross you can look at. I'm just going to quickly show you a back test and explain sort of what I'm doing as it's happening. Let's look at our entries. Our entries will be the moving average cross on whatever chart we have it running. For this test, we'll be using the 9 moving average. We're also going to be using the 14 RSI on the daily chart with 70 and 30 extensions. If we're above 70, we're overbought. We're expecting that pullback down. So we're overbought, plus on the lower time frame, we have a moving average cross down. We're going to enter our sells. For a buy, if we're below the 30 RSI and we have a moving average cross up, then we're entering our buys. In fact, I might actually run this on the 4-hour chart just so we get more entries and I can explain it happening. So I'll just explain what's happening as it's doing it. So we're waiting for extensions on the higher time frame plus the moving average cross. So we can see we got a nice sell for a take profit there because we extended up, then we had our cross down, so we take a sell position. I'll keep playing it. So obviously we're just waiting until the RSI is extended from our higher time frame. So in this case, we're looking at the 4-hour chart. So once the 4-hour chart is extended, plus we have our moving average cross on the lower time frame, which at the moment this is the M15 chart, then we can get our entries for sells. So we're above now, we might get a cross. Yep, we have a cross. Just zoom in right here on that candle. So now we're in shorts. The next thing you'll notice is that we have a spacer. So from this position to this position here, we have a minimum spacer. So we're not getting too many positions too quickly. We just take profit. If we don't, we're going to average in and use our spacers. So those ones will just all take profits. Now we're below our moving average. Sorry, we're below our spacer, which is this white line here. We haven't had a moving average cross yet. Once we have our moving average cross, which we just did there, we add our next position. Then we have a spacer for our next position. Notice, our first position was 0.15. Our next position was 0.16. The second position is gradually larger than the first. So if they were the exact same lot size, our average price would be right in the middle of them. Since the second one's gradually bigger, it's actually brought the average price slightly down or closer to where price is at the moment. We just keep playing. It's continued to move against us, so we add another sell. We're also only in 0.5% of drawdown, being wrong this whole distance. So we're using absolutely tiny lot sizes based on our account size. So we just keep playing. There we go. So price just ticked and gave us another entry with an even bigger lot size than the first 2. So now that it's closed off over here, all 3 positions were a profit, right? The first position was a slight loser. This one was a slightly bigger lot size, which was a slight winner. And then we had a nice winner at the bottom with an even bigger lot size. So we actually got out with a nice 0.25% profit on this trade. Now that our RSI is just sitting at 54, it's not above our 70s or below our 30s. So we're just going to wait until we hit one of our triggers. But anyways, you guys get the gist of it, right? The higher extension we wait for, the less entries we'll get. So we're currently just ticked into the 70 level, right? And we've added a sell. But if we wait for the 75 level, we may not even get this entry. That entry will be better because price is stretched more in one direction. There you go. So this is actually a really good example. I don't know if you saw, but price, we have it set to 30. 30 was all the way up here. However, RSI is currently at 17. Maybe if you had your RSI set to 20 or 25, you would have got an entry way lower. This would have been your first entry, not this. We'll see what it does anyways. It's around about 1% of drawdown at the moment. And we got out 0.25 anyways. What I'm trying to say here is if you use a lower RSI or a higher RSI, you'll get better entries because you'll get less entries. So you're going to wait for price to be stretched even more. The next thing is if you're looking on a daily chart, you also get better entries, right? Because the RSI probably on the daily chart was only extended down here. So you would have missed these two. And you would have only got your first entry here. So 1, 2, just two nice TPs. Same for this one. We're extended up on the 4 hourly. However, on the daily, we may have only been extended up here. We still got out overall profitable without losing any money. But if this were to continue to move against us, we'd be in trouble if we got in too early. So the key metrics you'll be looking for on the RSI is the time frame or chart you're looking at, what extensions your high and low triggers, and what period RSI you're looking at. So I guess the two important ones will be what period RSI you're looking at, as well as what chart you're looking at. Alright, so our period for the RSI is going to be over here. Right now we're looking at the 14 period. Over to the right of my head, you will see that we have our extension levels. We have 80, 75, 70, 30, 25, 20. Alright, so the more price is stretched down past these levels, the more stretched it is in that one direction. Obviously, if you wait for it to be stretched longer, the better entries you'll get. Let's have a look at the differences in the RSI periods. So right now it is the 14 period and it's quite jagged. Now, look what happens when I make the RSI smoother. So we're looking further back. We're looking at more candlesticks. Let's just put it on, say, the 25. So watch what happens to these spikes. Okay. Boom. A lot smoother. So we didn't actually get extended that many times. If I put it on like an RSI 3, watch how many times it's going to touch. Boom. So we've got to look at what RSI period we're looking at, as well as the time frame. So if I look at this in the 5 minute, it's going to be an absolute mess. You do not want to be getting your entries off here because we're extended over here. Imagine adding cells all the way up here. It's just not going to work out long term, right? So the higher the RSI period and the higher the time frame you're looking at, the better your entries will be, as well as waiting for longer extensions. Instead of maybe catching the 70, you might wait for the 75. So you'll get an entry here, but you won't get an entry here. Less entries, better entries, less drawdown. The next thing we're going to be looking at is moving averages. So let's get one on the chart. I'm going to put a 9 moving average on to start. So as you can see, the 9 moving average touches price quite a bit. Now if we go up a time frame, it obviously looks slightly different as well. So whatever time frame you have it set to is what the bot's going to look at. To keep it simple, let's just say we put a 25 moving average on. Watch what the line does. Slightly smoother. Now let's put, say, a 50 moving average on. Even more smooth. So it's touching price a whole lot less. So what I'm trying to get at is the higher the moving average you use, the smoother it's going to be and the less touches it's going to get to price. So the higher the moving average you use, the less entries you'll get, but also the better entries you'll get. And remember, we're using this moving average cross as our entries based off the RSI being extended on a higher time frame. So if you use a really stretched RSI and a really smooth moving average, and you're looking at a really high time frame, you get pretty good entries. Whereas if you're scalping, you might look on lower time frames, use a lower moving average and get these quick entries. So the next important thing is additional entries. So what do we need for additional entries for them to be good? Number one is we need a spacer between our trades. And number two is if we use a multiplier, so X multiplied. What multiplier do we use? Let's talk about spaces first of all. So as we're averaging into trades, we don't want to add too many trades at once. So we're expecting this pullback. If we add too many trades as we go down, we can blow our account before we have that snapback we're expecting. We don't want that. So we need to have some sort of minimum spacer where we add our trades nicely apart. This way we don't blow our account. We want to have them close, but not too close, and close, but not too far. So what I mean by this is if you're adding not enough positions and you're keeping them quite far apart, you're not going to keep your average price close to you when we have that snapback. And if we're not adding them enough and we have our snapback, it doesn't quite reach our break-even price, and then price continues down. If we had had more entries, our average price could have been down here, and we actually could have closed out in a little bit of profit. So we've got to keep our average price close to where price is, so we don't come up, just miss our take profit or break even, and then continue down. What we're doing is we're keeping our average price close to us, preferably in one average daily range of movement. And then obviously if they're too close, you're going to be getting in way too many positions too quickly. And this brings me to my next point, which is the multiplier. So the reason I use a multiplier is to help keep my average price close, so when we have that snapback I can get out. Let's just say we have the same lot size on these two positions. We've added one buy here and one buy here. All right. With using the same lot size, my average price will be directly in the middle of these two positions. If trade number 2 is slightly bigger than trade number 1, what that's doing is it's helping bring our average price down closer. So trade 2 is bigger than trade 1, our average price would be about here. Now that helps when we come down because it helps bring our average price with us. So when we have that snapback, we can potentially get really close to the bottom of that move, which is good for us. But now here's the tricky part. If you multiply it too much, you're going to be getting in a lot of trouble. Now if you're multiplying it as well as adding a lot of positions close, it can get very dangerous very quickly. So what you want to do is find the sweet spot of spaces along with the sweet spot of the multiplier, which will be very small. You're not going to double it. All right, this isn't martingale. That's how you blow your account. We might use a 1.2x multiplier or maybe a 1.1x multiplier. Very little, but that's just going to help us keep our average price nice and close. Obviously, the bigger the multiplier you use, the bigger lot size you're going to have on these trades. Also, the closer your spacer is, the more positions you're going to have on. All of this will affect your drawdown. The number one issue with people dollar cost averaging trading and failing is they're using too much risk. And honestly, a good risk to be using is literally 0.01 per $2,000 you have in your trading account. That is how little of a position you should be using with this approach. Now obviously my bot is a little more advanced than that, so it's going to actually use average daily ranges to calculate the risk, but that's just a visual representation of how small of a lot size you should be using with this approach. So in a future video, I'll actually show you guys how to find these sweet spots, how to test thousands and thousands of parameters all at once. So we have the different take profits, drawdown controls, pretty much just everything, all these different tests, different risk. I'll show that in another video, so look out for that. So that pretty much sums up the video. This one was our entries, so obviously we're looking at the RSI from a higher time frame as well as a moving average cross. So a general rule of thumb is the higher time frame or higher you set your oscillator to, the better entries you'll get. So obviously if we're waiting for the RSI to get extended more, price is even more stretched, meaning it's more likely to have that pullback. If we use a higher moving average, we're less likely to get the crosses. As well as looking on a higher time frame, we'll get less crosses once again. So maybe if you're getting better entries, you might risk a bit more. or if you're getting on a really hard daily extension, you might target a bit more. We'll get more into this in another video. And if you do want to see a bit more about my strategy, like and subscribe, because there's going to be heaps more videos coming out for free. And with that being said, cheerio.